Hi guys, good afternoon. Just give me two minutes or so, and then we'll get started. Thank you to everyone who's joined so far. I've just had a few messages in the background from a couple of people just saying that they're waiting and just trying to jump onto the link to jump on. So yeah, just give me 1 minute, and then we'll get started. Excellent. So yeah, I think we're there. It looks like the people joining now is slightly slowed down, but we've got a really good group here today jumping onto the webinar. So thank you to everyone who's made the time out of their day to hop on and listen into our webinar today. A lot of you, I'm sure, have jumped onto previous ones we've done and seen a lot of the webinars I've done in the past. A lot of these actually being more so on more sort of investment specific types of webinars. Today, we wanted to try and do something a little bit different, a bit more sort of educational for our investors. A lot of our investors that I'm speaking to at the moment are really interested about the ideas of sort of where to buy, what to buy, where are certain parts of the market going, what are these hotspots in these markets that so many people are talking about, and how do we get access to them? So that's what today's really about. So UK property hotspots, what are they? Where are they? What can we see from them? How do they work? And should hopefully that really the purpose of today is give you all a very good understanding about some of the different markets maybe you've heard of and might reaffirm your current thoughts, or actually give you a bit of a better idea in terms of other areas, other industries that we can get into and see how they're going to work for you. So just before we get started, for anyone who's new to GetGround, new to speaking with us, who are GetGround? So GetGround as an industry, as a business now, been running for the best part of 6-7 years, really maximizing that relationship with our investors and helping them with initially assistance with accountancy and tax services. We've now really developed into our all-in-one platform in which we're helping investors trade in property, so buying, selling property, doing full mortgage broker assistance, helping with lettings management, full service, all round sort of start to finish there to really help people get that investment success with their property portfolios. We're currently sitting right now with just over 30,000 active customers and a really large database of over 80,000 property investors that we work with. Really nice sized network of partners, sitting over 1,400 different partners, different types of lenders, broking agents, property agents, accountants, tax specialists, and with our remit around the world now in the UK, Hong Kong, Dubai, and Singapore. But certainly we're doing a lot of different types of properties across the UK and working with a lot of investors in most countries around the world. There's a slight bit on this slide here. I'm sure that anyone who's pretty good speaking to me recently will notice. Where it actually says we've transacted over 1.2 billion pounds worth of property. We've actually just hit over 2 billion. So yeah, just to make sure that's highlighted, we're actually doing very, very well, and things are really sort of moving in the right direction for us here at GetGround. Hence, doing more of these things and bringing on a lot more opportunities and products across the country, which we're going to touch into now and start discussing. So when we talk about buy-to-let hotspots, what do we actually think a hotspot is within the UK? How do we define that? So there's a few key ways that we can look at a UK hotspot and think about what makes it a good investment. First being growth. So we're talking about really strong economies in markets. We're seeing huge amounts of job creations. And one of the biggest things that we look at when we talk about capital growth in any kind of industry, and you'll see this, anyone who's spoken to me in the past, we talk a lot about graduate retention. So this is something that's really big to actually drive that long-term rental demand. So what is graduate retention? Basically, when we look at an industry or look at an area, and what we can see is the volume and number of students in that location, percentage-wise, then stay in that market post-graduation to start building their careers, renting property, building their lives in those cities and in those areas. So when we look at certain markets, even on this list here, which we'll touch base into a little bit more, we can really see how these areas are developing and growing and why they're being so attractive now for young professionals to grow and develop their careers in. Regeneration. So we're looking for markets across the country where we can see billions of pounds worth of public and private investment, reshaping the cities, really building that infrastructure. We see even certain locations with very small levels of investment, but all of a sudden in the last couple of years, investments of £10 million have turned to 100 million. Certain markets around Manchester, Birmingham have seen hundreds of millions turn into billions of pounds in really well privatized investment, ring fenced, and we're seeing the benefits of that really coming in now. When we talk about affordability, so one of the biggest, I'd say, objection points that people have had about UK property in the previous couple of years really has come down to the stamp duty land tax being one, capital gains tax, and really that sort of taxation piece. How do we combat that? Well, unfortunately, there's no sort of backdoor way to get around paying tax, unfortunately for all of us. So what we have to try and look at then is how do we pay the minimum amount and maximize our returns? So when we talk about capital growth, what we have to look at, and how I like to describe it, is we look for areas that are showing volume of transactions in those industries. We're seeing more properties being transacted on, which typically is why we see better levels of growth in hotspots on more standardized apartments and houses, as opposed to more rental specifics, HMOs, student accommodations, retirement homes, etc. So when we talk about volume, it's basically that we want to try and find the types of properties that more people are buying. Because of the changes regarding stamp duty, what we're seeing is a larger portion now of investors based overseas wanting to buy properties that are sub £250,000, so they can get rid of that initial remit of paying that additional 5% tax. Frankly, anything over £250,000, if you're based outside of the UK, you're paying around a 12% tax on everything over £250,000. So we keep it in that remit of around 100 to around sort of the £210,000, £220,000 range. Gives us a really good position there to get a property, pay a minimum level of tax, but more importantly, we're buying in that part of the industry where most people are buying. So we can see that momentum, we can see that volume, and that's what's really going to drive these markets for us to let us see that capital growth really sort of over the short and long term. So anything really between 5-15 years, we can see these levels of growth coming through. And then lastly, timing. So what we want to look for is this sort of early to mid regeneration phase. So we want to find this sort of sweet spot before the prices have really shot up. So we look at certain markets now, we're not necessarily saying go and buy in peak central Manchester, peak central Birmingham, peak central London. We want to start looking at what we call ripple effect zones in these areas where money is being spent. We can see the prices now starting to grow and spread out from the city centres, so we can maximize that ability for return. Or we look at newer cities, so more secondary city locations, which have now had the full sign off for the levels of investment that we want to see in these industries and in these markets. So to take a bit of a deep dive into some of these industries and some of these areas, just wanted to touch a little bit about these markets we're seeing on the screen, what are they doing, and how do we actually assess them for that level of growth. So we'll start with the furthest north property on here. So a property up in Scotland, talking about a market like Aberdeen. So if we look for what can we see? So Aberdeen recently has had a really big boom in commercial property investment. So for example, in 2024, we actually saw commercial property investment volumes. They reached around £357 million. So that's 3 times what they were in 2023. That's a huge level, a huge shift, just moving a market really quickly, really decisively, so we can see really quick levels of growth, shock impacts that mean these markets actually start to really stem and grow very effectively and very well. Now, having that lower entry price makes it really affordable for investors. And if we look at this kind of market, what we're looking there is probably more of an income-led initially short-term, so higher yields, lower prices, then with that real big benefit of growth potential over the next 5, 10, 15-ish years. So really, really key things to look at there. We look at somewhere like Sunderland. So major regeneration on things like the Riverside in Sunderland, the big master plan there. So we're seeing 32 hectares of former industrial land along the River Wear. So that's around a 29.7-ish million pound investment going in there, which that includes an investment of over 1,000 new homes being developed and produced within that market. Again, that kind of market more now stemming towards that sort of growth orientated market. Lots of volume, lots of transactions now happening, and we can see a really big push in that kind of market. Very similar to Middlesbrough. These are two areas very, very closely connected. Again, more so for growth. We've just seen the Crown Square project fully undertaken now in that market, signed a £200 million investment to redevelop that a lot of the derelict central sites in the city centre to really grow and expand that market. Again, we're talking at properties here around the 130k below, so really nice sort of low entry points for newer investors to really build that baseline of their portfolios. Bradford, we look at Bradford as a market recently voted as the UK City of Culture. Whenever we see a market getting these kind of accolades, that typically follows with a large sum of investment then putting into that market. Now, in that kind of area, we're seeing yields of around 7.5, 8.5%. So really strong rental yields in comparison. And we're talking like AST, standard long-term rents. Somewhere like here, we're talking initially the income-led type of investment, but with all of this money that's now being spent there, that's where that growth potential is going to come from. Again, we're probably talking between 5-10 years to really see that significant level of growth. Moving on to, say, Leeds. So this is a really interesting one because Leeds has now become quite a large market. I think it's a very well-known area now worldwide. A lot of people inquire about Leeds. And that's because it's one of those interesting markets which kind of gives you the best of both worlds when we talk about growth and we talk about rental yield. So we can see huge regeneration. The South Bank regeneration in Leeds is a £500 million project. We're seeing 8,000 new homes already penciled in to be developed. Average yields are around sort of that 6 to 7.5%, with the student areas of Leeds actually producing around 7 to 10%. That alongside a really strong level of capital growth, we're seeing around sort of the 6-7% growth per annum. Gives us a really well-rounded investment, really strong returns, and so it's going to be very consistent for the next, again, 5 to 15 years. Hull, I'm sure a lot of people, I've actually seen a few familiar faces in the webinar today who I've actually spoken to about some of our most recent investments in Hull. Really big thing here, rental yield. Really strong rental yield. We're seeing the best parts of around sort of 8 to 9% yields on a standard AST. A market which has got such a huge driver now in the industry there. Lots of money spent on the renewable energy sector. If we're looking at the student demand, the retention rate in Hull has increased from around 30% up to 40%, which again means we're getting more young professionals, more demand for good quality, newer properties in that region to actually give that payoff against young professionals wanting good quality homes, central locations, good working opportunities. Manchester, I guess, people have probably heard a lot about Manchester. And I think, as I mentioned earlier, we're getting into that position now where if we're talking smack bang city centre, it's a powerhouse in the sense that you can get into a market here. It's going to hold its value very well. But the key designs now for Manchester are starting to push further out of the city centre, looking for markets like Trafford. If you're pushing a bit further, sort of northwest, northeast of the city centre, we're now starting to see that ripple effect coming out. Really big plans. The Trafford Waters regeneration is about around £1 billion investment on the waterfront there, along with the full regeneration of the Trafford area, including Manchester United's football ground and everything involved with that. Definitely those kind of markets, more growth than yield, just because of the fact that prices have increased, but there's still a lot to be seen in terms of growth within particular regions in the city. Stockport as a market. So Stockport's really benefiting from that kind of spillover from the Manchester city centre. So we're seeing some really strong developments. We've worked on a few things recently, places like Weaver's Yard in Stockport, where we've seen yields of around sort of the 9-10% ability in there. Really strong sort of short-term letting investment plans. So yeah, really sort of strong secondary city, commuter towns, strong income with potentially long-term growth. Liverpool, one of the biggest, probably most exciting regions now in the UK. We've got the Liverpool Waters and Wirral Waters investment plans. They're part of what's called the Ocean Gateway investment in the UK, which is a £50 billion investment of the northwest of England. We are seeing a lot of demand in Liverpool, really good yields, really strong growth. One of the most difficult things about Liverpool is actually finding opportunities, which is something we definitely, we're always on the hunt for and looking out for. Certainly, if anyone's interested to find out more on that, let me know. We've got a new site in Liverpool we're going to be launching very, very soon, which will be very exciting. Again, high yields, strong levels of growth. Derby, another one, more income-based. It's a very good central location in the UK. It's actually been seen as one of the best regions for buy-to-let landlords by the Times, and really good sort of supply linked demand, and really strong. I'd say the supply and demand balance is going very, very well in Derby. We're seeing that good level of income and moderate growth potential right now, which is, again, balancing a very nice investment. Similar with Nottingham, again, central, really strong student population, leaning slightly more towards income, just because of the steady rental base, but there's a lot of growth, a lot of money now penciled in to be spent there. So a real big focus there is to focus on student young professionals in these zones, and that there's certain regeneration corridors around the city centre, which, again, very interesting. And then lastly, we have Coventry. So Coventry, again, very, very strong regeneration story. The city centre, it's called the City Centre South project. There's a development right now of about 1,500 new homes, about 8,000 meters squared of commercial space, and it's part of a £450 million transformation of the city centre. We've actually had a huge amount of build-to-rent conversions in the city centre, and that's actually been development loans of around £16.3 million directly from a lender such as HDB into the city centre as part of these big regeneration and rehousing projects. Primarily growth orientated, whilst again still offering income opportunities with really good stock, but you're talking probably between 6-7% income, but the growth looking more like sort of the 7-8% levels, which works very, very well as a really strong level of growth. Now, with any of these markets, any of these sort of industries, I'm more than happy to sit down with anyone, have a really good discussion about them. I've got, countless amounts of documents and files and presentations and data that we can sit and talk through and make a lot of sense of all of this and show a lot more of the background. How do we get these figures? Where's this all coming from? So at the end of this presentation, you'll see that there's a booking link as well. Feel free to book in. You can jump on, have a chat with me, and we can run through this all, in a lot more detail on an individual basis. But what I wanted to do then was just give a bit of an idea. So I picked out of most of these markets we have opportunities in right now. I thought I'd pick out a couple of stand-up developments just to show everyone a bit about, what do they look like? What do we see? What kind of things could I actually get in these types of areas and in these markets? So we'll start off with Leeds. So right here, we have an opportunity called District Lofts in Leeds. Completion this year, as you'll see. So very, very close to being finished. Yields around 6%. So one beds start from about 225,000, two beds from 285,000. We're talking about investment capital, deposits from 45k for a one bed, deposits from 57k for a two bed. So again, a good market to get into with relatively affordable properties into a city centre that is expanding massively. Where we are with this project is in a really good part of the city, right along the river, part of the new regeneration zones within Leeds. So we're seeing all the brand new museum quarters around there, lots of the new food halls, shopping centres, all based around this development. Again, can happily sit down with anyone and take them through brochures, maps, and a really good understanding of exactly what, why, how, with this development, how it all comes together. As mentioned there, it's located in that South Bank expansion. So it's about a £500 million investment surrounding this property. So we can see we're in a very good spot within the city centre there. Loam House. So we mentioned there about Derby. So if we're looking at getting into investment, we maybe don't have the capital amount to get into Leeds. Well, if we're looking into Loam House, we can get into a one bed for about 180k, deposits from 36, a two bed from 230k with deposits from about 46k, yields around 7%. Completion looking at Q1 26. So again, we're still talking completions within a 6-month range. This is massively sitting in the middle of a £3.5 billion regeneration pipeline that's hugely developing the city centre. There's a lot going on there, a lot of specifics and things we can break down into to really look at. It's got the second highest income per person outside of the southeast, and it's the sixth most productive UK city. So what we're seeing here is a really good market for affordability for working professionals in this market. We're looking for a level of affluence, so we're looking for good quality tenants who will be looking after property, paying on time, and working really well. And it's at the centre of the Beckett Well live regeneration. So it's a really big cultural and residential hub within Derby, and part of a big expansion there for the city to grow and develop even more so again over the next 5-10 years. We're going to see really good levels of growth and return coming off of this investment. And then lastly on these, we've got this development here called City Point. So City Point is an investment that we're working with in the city centre of Hull. Prices there for 1-beds. Actually, we've actually still got a couple of 1-beds here starting from around the £120,000 range. With 2-beds, there's actually a couple of 2-beds sitting around 150 as well. So there is a good level there for getting in a really low price. Some of the deposits sitting at around sort of 30k for 1-beds, around 35k for 2-beds. It makes it a very, very affordable market. We've actually just hit completion in this building, and I've seen some yields between sort of 7 to 8% coming out of this project. In terms of investment into the city, Hull has received £1.5 billion of investment over the last 8 years. And that's, again, because it was crowned the UK City of Culture back in 2017. So similar to, as I mentioned about Bradford, Hull is that little step ahead in terms of the investment it's already had now as part of the development there. Hull Port handles approximately 10 million tonnes of cargo annually. That's 12 billion in trade each year. It's actually what's referred to as being a free port city, which for businesses based in that market is a very beneficial thing in terms of tax and affordability. So businesses makes it very attractive for organizations to be based in Hull, which again, when we're talking about that retention rate, is why so many more students are now deciding to stay in Hull to develop and further their careers even more so in the market. And it's within that Albion Square master plan. So it's around £96 million worth of new retail, leisure, and housing in the city core. So it's a really strong part of this region, part of Hull to get into. Again, to design very much for working professional tenants for a hands-off, very easy style of property investment. So that's that sort of overall summary there about the investments we're working with at the moment here at GetGround, some of the regions that we're looking at, some things that we're very, very excited about to be working on. I've already seen a few questions that have come in as part of the Q&A at the bottom. So what I'll do, I'll get to answering some of those questions. Of course, if there's any other questions that anyone has, please at the bottom of your screen, you should see the Q&A section there. Put some questions in. Use me as much as you need to. Let me answer some of these points and questions that you have, and we can discuss even more so on all of this. If you do just want to book in for a call, you'll see the QR code there on the screen. Please feel free, book a meeting in with me, and we'll sit and have a really good discussion about everything we've gone through today, or to even actually discuss more so about particulars of developments, areas, anything at all we want to discuss and to look at. So first question I can see here, which is a very good question, by the way. It's something that's come up quite a bit over the last couple of months regarding renters reform bills. What does that look like for these types of properties? How are we trying to cover off against any changes? Well, to put it frank, and thanks Mark for putting that question in, by the way. When we think about the renters reform bill, the biggest change that we're going to see here is just more regulation when it comes to protections of tenants. And in my personal opinion, protections of tenants is never a bad thing. What we're looking at is a regulation that means we have to actually take a bit of consideration as landlords with our properties. We're talking about efficiencies within our buildings. We're talking about the conditions of which people are living in. These are the big changes. The only people these are really going to affect are people that aren't on top of their properties or using a well-run asset management team to actually look after their investments, which is exactly what we do here for our investors as part of our full complete plan service that we run for our buy-to-let investors here at GetGround. The one other change, which is something to be aware of, I guess, is the change regarding EPC ratings. So EPC ratings on these types of properties is going to be changed to having a minimum EPC rating of a C grade, which is going to be brought in over the next few years. How it's been put forward is that by the start of 2028, any new tenancies will not be able to go through unless the minimum EPC term of a C grade is there. If it's an existing tenancy on a long-term plan, there will have to be the property will have to be to that standard by 2030. How do we get around that? How are we dealing with that? Well, frankly, any properties we're looking at here are EPC compliant, or will be anything between an A to a C grade, with most sitting around the B to A rating because they are newer properties. So we're already getting ahead of that by buying a property that's well ahead of everything regarding EPC ratings, any changes regarding ESW1 regulations. But again, if you want to discuss that in a bit more detail, you'll see some proof and evidence and look at some EPC ratings. Book a call in, let's discuss it. But thank you so much for that question. Let me know if you need me to expand anything further, or again, book in, let's talk about it even more. I got a question here. Should I wait for the budget to come out? Will that impact that? Well, that will impact the market. I don't know who asked the question. It just says anonymous attendee, but again, thank you so much for the question. Really, really good point, frankly. When we think about the budget, and it's probably more so to the idea that I've had this same question easily. I've worked in the industry for the best part of about seven to 8 years now. It's definitely been there. Feel like a long time. Honestly, if I was to sit here right now and tell you that there's a perfect time to invest, I'd be lying. There's never a right time to invest. There's never a wrong time to invest. Frankly, when we look at things that change in the market, I would say that any turbulence in the industry, any turbulence in the market typically creates opportunities. And it's normally the professional investors who really thrive with the idea of opportunities. And it's one of the oldest sayings. It's one of the things that I got taught when I first even started getting involved with investment, particularly within property, is that it's not about timing the market, it's more about time in the market. The longer you're actually invested into property, the better returns you're going to see over time regardless. Property is one of those assets where people have to have somewhere to live, and prices will continue to go up and up and up, as we've been seeing consistently. I got asked the same thing about the Brexit vote when Brexit was getting put through, COVID, the initial war in Ukraine, the cost of living crisis, all of these things. And if we actually look at it, and I've got a lot of data to back this, by the way, so if you want to really go into this, as mentioned there, jump on, let's have a really good discussion about this all. But every single, what we'd say, market-breaking event that's happened in the industry over the last 8 to 10 years, property prices have continued to excel. And the things backing that are frankly that we aren't building enough properties in the UK fast enough. We're so behind on those numbers that the supply and the demand is so skewed right now that even if there was something that changed, and again, think about things that could possibly be really introduced. We already know that the full regards to do with the renters reform bill, anything to do with tax. We saw a stamp duty tax hike last year. We saw a second one come in April this year. Prices have still gone up. Investors are still investing. Buyers are still buying. People are still buying their own homes because property is a commodity that isn't just going to die out because people need somewhere to live. And for as long as there's a lack of supply in the market, they're going to continue to grow. But yeah, again, it's a really good discussion to have. So if you have any more questions, I hope I've answered that to the best of sort of an understanding piece there. But really, I'd say that the big takeaway from that is prices aren't looking like they're being shaken. There's a lot of, say, headline hunting where a lot of major news outlets will be saying prices in the UK dropped by X amount. Frankly, what they're doing is they're talking to you about central London, where people just aren't buying because it's ridiculously expensive and people either can't afford, or if you're buying a property in central London, you're paying hundreds of thousands of pounds in stamp duty. People just aren't doing it because it doesn't make logistical sense. They're skewing those figures across the whole of the UK. So an important thing to think about is different industries, different markets. Where's the money being spent now? and where that growth is. And again, it's kind of what we've been speaking about today, but please, let me know if you'd like to discuss it even more, book a time in, and we can discuss it even further. I've got another question here saying, actually, which of the 3 developments would I recommend? I would say it's not as simple as saying, buy this one or buy that one. They all have different perks behind them, frankly. A lot of that comes down to what you actually need as an individual. Property, it's not a one-size-fits-all investment. There's not a what is a good investment or what's a bad investment. There's different strategies, there's different methods of doing this. So if you're someone who needs an income right now today, and I want high yield, good level of growth, income today, you'd go and buy something in Hull. If I wanted something that, for the long-term plan, I've got something in the next 10, 15 years is going to do really well, major city location, going to grow, going to do well for me, and part of a really strong portfolio, you'd go for something like Leeds, for example. So again, I would always recommend anyone, if they've got any thoughts about what, why, how, in what way should I do this, what's going to be best for me as an individual. That's why I like to run strategy sessions with anyone who's talking to us at GetGround about what to do, so we can really try and work out what the best option would be, and then we can figure out that plan moving forward. But again, I'd say that best thing to do would be to have a chat with us so that we can help you out with that and figure out what the best plan would be. Just see if there's any other questions on there for me. I've got one question there. Was if I'm interested, what should I do next? If you're interested, again, scan the QR code at the bottom. Let's hop on. We can talk through the full reservation processes. Basically, with these opportunities, we have them exclusively, so we can secure these directly off the market straight away. So if you are interested, we can get a unit locked in for anyone to get them sorted, get them locked in, and get you beginning with the process of buying the property, which again, at GetGround, we can help with the full package of purchasing. So securing the unit, securing the finance, getting everything done, assisting you all the way through to exchange and completion to actually see that all come to fruition for you, and have that property done, rented out, and managed by us if that's what you would like us to do. Just give another minute or so if there's any other questions. Any other questions anyone wants to pop in, I'll give it another sort of minute or so to see if anything else comes in. No, okay. We'll leave it there then. But as mentioned, if anyone wants to discuss this further, please just let me know. And excellent. We'll have a really good follow up and talk through anything that anyone would like to discuss with me. But thank you so much, everyone, for your time. Really appreciate you all jumping on in the middle of the day. And brilliant. We'll speak later on. But thanks so much, guys. Thanks for joining. Cheers.